In this video, we're going to look at a crypto trading strategy that I've just back tested to give a 65% win ratio, which is insanely good. Anything with above a 55 or 60% win ratio is wildly successful. So we're going to have a look at that, how to implement it, what it is, and then some of the changes that I made personally to this strategy. It's called the Hoffman trading strategy. It's actually just an indicator on TradingView that you can use for free, which is really great, to give you an idea of trading with a trend. We're going to go through exactly how to implement it, some of the pros and cons, and some of the things to think about when implementing this strategy throughout this video. All of the different timestamps are in the description below. Firstly, a crypto trading platform with very low fees and TradingView, which you're going to need. Bybit is really good. They'll give you a deposit bonus if you're new, up to $4,000 in your futures trading account, which is awesome. MEXC, if you're in the States, may be easier. They give a very similar deposit bonus up to around $4,000. I'll leave them linked in the description because that's a great bonus for both of those. But then we need to go over to TradingView as well. This is completely free as a platform, and the indicator on here is completely free as well. Now, this is a strategy used by someone called Rob Hoffman, who is, an award-winning trader who's won plenty of kind of competitions in his time, and it's a free indicator on TradingView. So come over to indicators and then just type in Rob Hoffman, as you can see here, and it's Rob Hoffman's inventory retracement bar. Now, I'm going to go over this strategy and exactly what it means, but you can see once that's on the chart that you get these arrows right here, green arrows and red arrows, and they're going to give us our indicators on when to actually go ahead and place trades. The key to this strategy is identifying where the trend is headed, so either an uptrend or a downtrend, then getting the retracement candle or the retracement inventory. So I'll show you what the strategy actually does. Firstly, what we're looking at, of course, is whether the market is in an uptrend or a downtrend at the current time. So that's obviously important to understand. After that, once you've decided whether the trend is an uptrend or a downtrend, you're going to get these things right here, which are the retracement bars. And these are important to know because they're the indicators. Now, a retracement bar is a bar which retraces more than 45% from its high or low. And it depends whether you're in an uptrend or a downtrend for that to take place. You can see that each of these candles right here is a retracement from either the high or low, dependent on the trend. So this red candle right here is looking at an uptrend, but this high, this very, very high from this candle during this time period, which is the 15-minute, where the candle ended, which is, as you can see right down here, is at least 45% away from that high, and then and only then does it print this this arrow that we can use to trade off. You can see many candles that don't retrace don't get any arrows. So what we're looking for is a retracement in a candle. Now, what this is actually telling us is during an uptrend, which this clearly is, has the trend got overheated in some way, as you can see here. So the price has shot up significantly more than the trend, and then pulled back and reverted towards the mean of the trend again, or some sort of trend line. So what the strategy is really doing is saying, are there candles that got a little bit too heated and have retraced more than 45% away from that high during that specific candle? And if there is, we can print this as an indicator, because the price has come back to what we would say is reverted to mean, reverted to the trend line. And we can use this as saying the next time that the price goes above this could essentially be another breakout from the trend. Now, remember, if we are indeed an uptrend, then we should obviously be breaking out above this high at some point, but you're looking for a better entry right here. You can see exactly what happened here, that when the price did break through, it really did break through, and that would have obviously been a good entry after this candle. So that's what the strategy is trying to do, essentially get you a better entry into a breakout after a reversion back to the mean, and then another breakout into the uptrend. Here's how to go and implement this on the chart then. So obviously we have the Hoffman indicator right here. Now on the right hand side, you want to turn off log. You can just see this here. I'll just get rid of myself. You want to turn off log down here, and you want to turn off auto down here as well. And you just want to go ahead and reset the chart. So if you right click and then press reset chart here, that's going to give you everything as it should be. Now what you want to do is place 2 exponential moving averages on the chart. Now you can play around with this if you like. What I've done here is a 20 period EMA. So you can see the length is 20 periods. Now I'm on the 15-minute chart right here. So that's each candlestick is 15 minutes in length, and that will be the last 20 periods of 15 minutes. Put the style on as you want. you can see the style for me is red. So that 20 period is red. Now, the second EMA is a little bit different. You're going to choose this on a longer time frame. And the reason for this is because you want to confirm the trend. So if, and this is green, by the way, so you can see the green trend line here. This is tracking the chart over a longer time frame than the price, the candlestick prices are telling me. So this is essentially just giving me a longer time frame exponential moving average to plot against the red line, which is the shorter time frame. And that is going to confirm for me the short-term trend and also the long-term trend, right? So not just the same or different exponential moving averages, but an hour chart that the green line is plotting. And so that's going to give me a difference between shorter and slightly longer. And so for an uptrend, of course, you're looking for the red, that's the shorter period, being above the green in this instance. So you can change any color you want, but this is all an uptrend right here. And of course, in an uptrend, you only go long. Now in a downtrend, it's of course the exact opposite. So you're looking for the shorter term to be beneath the longer term. And of course, with these, we're only going short because this strategy is at the heart just a trend following strategy with the indicators trying to get better entries with a breakout, continuing the trend. Now, something Rob Hoffman says in his strategy is that he waits for trends to have a 45-degree angle, and that indicates an extremely strong trend, which is obviously good to trade with. That's fine. For me personally, I like to go a little bit less than that. So anything around a 28-degree angle up to around 30 degrees, sorry. If it's above that, then I'm really happy with it. So as you can see here, this is a 30-degree angle trend. Everything above this is obviously great. If you're getting down to around 20%, then obviously the trend isn't as strong, and you're probably going to get some more choppiness, and your win ratio is going to be less. So you can go over to the angle right here and draw a trend line, go down to trend angle, and then just put that on the chart. So a 30-degree angle to the upside, or if you're in a downtrend, of course, somewhere around 28, 30 degree in the downtrend as well. Any trend that isn't at least that, maybe consider not trading it because it's going to be a weaker trend that will not give you as good of a win rate. So once you've got your EMAs and trends in place, where exactly do you place your trades? Well, now you use the indicator to do so. So what we can do here is wait for an indicator to tell us that we should be trading. So I'm going to zoom in right here and show you this indicator. Now, in an uptrend, what we're looking for is a reversion back to the mean. And then we get that indicator, then we open a position just above where the indicator prints on that candle. So I'll show you this because it's easier to see. We want to enter a long position when we're in an uptrend. We've seen that this angle of the uptrend is 30 degrees, and that's good for me. I'm not going to wait for 45 degrees. Now we see this right here, which is a red candle showing us a reversion back to the mean. But you can see right here is the very top, the very high of that candle. So the next time that the price gets there, we are going to open a trade. So what you can do is come over, and obviously the next time that we trade at that price is right here. So that's where you set your entry. So you don't set any of your entries down here. You wait for the price to reach this again. It's actually quite a clever part of the strategy because what you're doing is essentially waiting for a breakout of that reversion. So it's a very clever part of the strategy. So once you see the red, now when you're in an uptrend, you have to see the red reversion down towards the mean. Then you place a what would be a stop order. So I'll go through that very shortly. So we're looking for this price again. So we just open right just above that price, looking for a breakout. And this candle, this is the candle that we're trading. We want to place our stop loss just below the low of this candle. So we're going to do that as well, which would be right around here. Now, these 3 or 4 candles in the middle have passed us by. We haven't traded those because the price hasn't got to where we want. Now we want to open the price here. Now, what you can see is that this trade would have been triggered right through this breakout on this candle. Our stop loss would have been, in this instance, quite large actually. This was quite a large candle, and the stop loss is quite large, which means that our risk reward ratio has to be large on the upside as well. I'll go through that in a second, but you'll want anywhere from kind of 1.3 to 2. So we're going to look at the risk reward ratio all the way up to 2. We would have actually had a great trade, but let's put it at 2 right here, and that would have been a good candle. So you open just above where the previous red in an uptrend, red indicator prints, you place a stop order there to open, stop loss just below the bottom of that candle, and then you can choose the risk reward ratio of your choosing. In a downtrend, it's the exact opposite. We're looking for a green candle reversion and opening a short trade after that as well. So we come over, we can see this. I'm going to choose a short position here. So we can see this green print. You can see we're in a downtrend because red is below green here, and the angle is sufficient for me. So when looking at this green, what we're now looking to do is open an order, a short trade, if the price gets below this again. And the first time it gets below this is actually about 6 or 7 candles after that. And we're going to enter a stop order just below this candle, which would have been right here. And we put the stop loss above, because we're now trading short, just above this candle, which would be right around here. So opening at this level and having a stop loss up here. And then we're looking at a risk reward of maybe 1.5 or something like that. And we can see that our risk reward of 2 would have gone through, and it actually would have been a fairly long trade, but the price never got anywhere near our stop loss. And we would have either ridden it down here if we were looking for 1.5, or all the way to around this level, this candle here, if we were trading in a 1 to 2 profit ratio. So as you can see here, that would have been a winning trade as well. Now, the key to this strategy is opening what is called a stop order. And that is an order where you actually open at a specific price in the future, and you don't want the system to trade until the price reaches that level. So you can do this on trading systems. You can see here that we don't place a limit order because we'll actually get triggered at the wrong price. We want to essentially place a breakout trade at a specific level. And the way that you do that is going and placing a stop order. So on something like MEXC, they actually call it a trigger limit. You can see that right here. So you don't want a limit or a market, you want a trigger limit, and then you can choose the exact price that you want to enter the trade at. So you enter the trigger price, whatever that may be, and then you enter the price. Now, make sure they're exactly the same. You want that exactly the same. What you're telling the system to do here is only trade when the price gets to the price that I want, and trade at that same price. So these both can be 20503, so they can be exactly the same price, and then choose your quantity. If you want to do it on something like Bybit, then they call it a conditional order, where the trigger price is only when the system trades, and the order price would be the exact same price. So this is called a conditional order, or a trigger limit, or something sometimes called a stop order. It's the same thing. That's what you want to use. Now, when it comes to a risk reward ratio in terms of how far away do you want to take your profit, this is open to each trader. Most traders will not trade anything under about 1.3, and they may even go to a 1 to 2 risk reward ratio. Just to give you a kind of example of why that's important, if you have a 1 risk reward multiple, you have to win 50% of the time. If you have a 1.5 multiple, meaning that the profit right here is at least 1.5 times the potential risk, then you only have to win 40% of the time. Now, if your risk reward multiple is 2, you only have to win 33% of the time. And so most traders will stick around this level, 1.5, maybe 1.3, something like that. But anything under that, and it's essentially just not a good ratio to trade at. So that's what you want to be looking at in terms of taking your profits. Every trader can choose this as they want. So the Hoffman indicators gave me a really good win rate for both the 1.3 and the 2, as you can see here. So the 1 to 1.3 risk reward ratio, so that is actually taking profits earlier, got more wins than waiting for larger profits. 13 out of 21, so that's a 65% win ratio, which is really good. You take a profit when the profit is 1.3 times the risk, and you take your profit there. The 1 to 2 ratio, you can see it doesn't win as many times. 11 to 20, the win ratio is still 55%, which is actually very good as well. The win ratio is less, but you're obviously making more in terms of each trade. You're letting run a little bit further, which means that you don't need to win as many times, and you're making much more profit per time. So for both of these strategies, the win rate is very, very favorable for this. I was really impressed by the win ratio here. I think waiting for a very strong trend to identify and trading on that is a great idea. And it's just giving you some very clear levels to trade breakouts. One of the downsides of this, though, is for me, you kind of tend to overtrade. Whereas, what I would have done was just hold this all the way up and actually just made one good trade rather than taking profits early and having to re-trade all of the time. But that's what day trading is. And obviously everyone's different in how they want to trade, but the win rate is very good, albeit only over 20 trades. If you want to try this out, deposit bonuses on Mexi and Bybit, I'll leave them linked in the description. Two good platforms that I use, and deposit bonuses are always great. Also, let me know what you think of this strategy as well in the comments. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.